In Bangladesh, the cost of borrowing has been increasing at a record speed. In just 2 years, Bangladesh Bank has increased the policy rate from 5% in May 2022 to 10% in October 2024. The impact? Financing is costlier, the new investments are hard to come by, and profits are being squeezed. So the real challenge for companies are how they can continue to fund their short-term needs and also chase their long-term ambitions without being crushed by higher interest rates. I'm Kashfia Binte Hassan, an analyst at Lion City Advisory. The answer lies in smarter financial tools, which can be securities. Securities are tradable instruments that help companies raise their capital from public or private market. Now, securities can be of three types. Firstly, equity, which gives holder the ownership rights. Secondly, it can be debt, which is basically loan, which has to be paid in periodic payments, and hybrid securities, which is a mixture of both equity and debt features. Now, today, let's talk about debt securities. These are financial instruments that gives a particular promise from issuer to holder that it must be repaid on a particular specific period, either at maturity or through scheduled payments. Now, as these are negotiable, these can easily be traded on secondary market. Now, in Bangladesh, debt can be issued by both private sector and government. In private sector, we see zero coupon bonds, coupon-bearing corporate bonds, convertible bonds, ESG bonds, Sukuk bonds, Tier 1 perpetual bonds, Tier 2 subordinated bonds, etc. In government side, we can see Treasury bill, Treasury bond, Bangladesh government Islamic investment bonds, Sukuk bonds, and also there is one thing called diaspora bonds. Finally, corporates can borrow money in two broad categories. Firstly, long-term, and secondly, short-term. In long-term, there is bilateral loans, which means borrowing from a single bank. Though it's simple, it's limited to that particular bank's capacity. Secondly, it can be syndicated loan, which means a large loan arranged by one lead bank, under which multiple banks participate in this loan under one particular contract. Thirdly, there can be club financing, which is similar to syndicated loans but smaller and more balanced. A few banks lend together, usually without one lead arrangers, and each takes a fairer share. Fourthly, there can be corporate bonds, which can have different structures like serial maturity, term maturity, and sinking fund provisions. There are also some low-cost funding options available for green and energy-efficient projects at around 5 to 6%. We also work with DFIs for foreign currency low-cost loans. Now, let's talk about short-term loans. There's only one, particularly commercial paper, which is often issued by companies with higher credit ratings. Now, here's the challenge. Debt financing isn't just about raising money. It's about doing it strategically. The right instrument, right structure, and right timing can help your company grow, diversify, and stay resilient. The wrong approach can create unnecessary costs and risks. This is where Lion City Advisory comes in. We are not just consultants, we are partners in your financing journey. We can help you in choosing the right financing instruments, structure bonds, or Sukuk that attract investors and lower cost. Also, design syndicated or club loans for scale and flexibility while staying compliant and maximizing strategic advantage. At Lion City Advisory, our mission is simple: turn complex financing challenges into smart and sustainable solutions.